Hello friends, today we are discussing on option chain analysis. An option chain provides in-depth information about the available option contracts for a certain underlying stock or index. It mainly shows all the calls and puts available of an underlying for particular expiry. The list of options are sorted based on the strike price and it display data on premium, open interest details and implied volatility. What is an option chain chart? An option chain chart is a listing of call and put options available for an underlying for a specific expiration period. The listing includes information on premium, volume, open interest, etc. for a different strike prices. NSE, National Stock Exchange, provides you with option chain charts for all trading options. Let's first see how an option chain chart looks like and understand the various data available in it. First, visit www.nscindia.com and search for the desired option like equity option chain in the search bar available at home page. Second, you will find following image. Third, you can view data by selecting index wise or particular stock wise. You can see in the above image that I have selected Adani Ports as a stock and 24 November 2022 as expiry date. 4. After this, you will see the option chart like below. Understanding various components of an option chain. 1. Option type. Options are of two types, call and put. Call option, it is a contract that gives you the right to buy but not the obligation to buy the underlying at a specified price and within the expiration date of the option. Put option, it is a contract that gives you the right to sell but not the obligation to sell the underlying at a specified price at within the expiration date of the option. Second, strike price. Strike price is the price at which you as a buyer and seller of the option agreed to exercise the contract. Your options trade will become profitable only when the price of an option crosses the strike price. Third, open interest (OI). OI is a data that signifies the interest of traders in a particular strike price of an option. OI tells you about the number of contracts that are traded but not exercised or squared off. The higher the number of OI, the more is the interest among traders for the particular strike price of an option. 4. Change in OI. It tells you about the change in the open interest within the expiration period, the number of contracts that are closed, exercised or square off. Value. It tells us about the total number of contracts of an option for a particular strike price are traded in the market. Volume is calculated on daily basis. Volume can help you to understand the current interest among traders. 6. Implied volatility (IV). IV tells us about what the market thinks on the price movement of the underlying. Higher IV means the potential for high swings in price and low IV means no or fewer swings. IV does not tell you about the direction, whether upward or downward movement of the price. 7. LTP. It is the abbreviation of last traded price of an option. Net change. It is the net change in the LTP. The positive change means rise in price are indicated in green, while negative change means decrease in price are indicated in red. 9. Bid quantity. It is the number of buy orders for a particular strike price. This tells you about the current demand for the strike price of an option. 10. Bid price. It is the price quoted in the last buy order. So, a bid price higher than the LTP may suggest that the demand for the option is rising and vice versa. 11. Ask price. It is the price quoted in the last sale order. 12. Ask quantity. It is the number of open sale orders for a particular strike price. It tells you about the supply for the option. 13. In the money, ITM. A call option is in ITM if its strike price is less than the current market price of the underlying asset. A put option is in ITM if its strike price is greater than the current market price of the underlying asset. 14. At the money, ATM. When the strike price of an call or put option is equal to the current market price of the underlying asset, then it is in the ATM. 15. Over the money, OTM. A call option is in OTM if its strike price is greater than the current market price of the underlying asset. A put option is in OTM if its strike price is less than the current market price of the underlying asset. The highlighted part is in ITM while those in the white are OTM. So, for all option, strike prices lower than the current market price of the underlyings are highlighted. For put option, strike prices greater than the current market price of the underlying are highlighted. Thank you. Please like and share and also subscribe the channel.